In this video, you'll be learning about this topic.
And then for me, I think the most critical thing that I've learned, and again, this is, I still consider this to be quite early, hopefully, in my career. Just like Toby said, hopefully there's a long runway ahead for all of us. But I think my empirical observation has been that the best investments in the stock market over time come from the best companies. And so if you're trying to be a long-term investor, if you're truly thinking of yourself as a part owner in a business, you want to own quality businesses that can compound value over the long run, especially when you factor in things like taxes and other frictional costs that go along with turnover. If you're a long-term investor, you want to own good companies. I had an intern this summer who put together a list of the top performing stocks over the last 15 years. And I chose 2005 because I wanted to see, sort of the middle of the last cycle. You see a lot of things like what's the best performing stocks in this bull market. And that will, as we were talking about earlier, that's going to catch a lot of these survivors that just barely hung on, did not go bankrupt, but survived. And you're going to see a bunch of those types of winners if you start in 2009 or 2010. But in 2005, it's sort of like the middle of the last cycle. And when you look at that list of the top 100 performers, they're all really high quality companies that have, survived over now 2 different recessionary periods. And so if you're a long-term investor, if you're thinking of sort of the coffee can approach to investing, which is sort of how I think about investing, then you want to own quality companies. And so my mistakes have always come from when I've purchased a stock that looked very cheap on the surface, but in reality, it might have been 10 times earnings, but it might have only been worth 7 times earnings. So I've made that mistake numerous times. And conversely, some of the best investments I've made, and this is something that is not just 2020. 2020 is sort of in vogue when it comes to this because there's so much momentum, but where I was very convicted on the business, but other investors questioned, I guess, the valuation at that time. And so some of those investments have turned out to work very well. And so I think a business is not worth what it earned last year. It's what it's going to earn over the course of the life of that business. And so I think that's something to keep in mind as well. So just buy good businesses. Obviously, you have to pay a price that is discounted in order to achieve alpha in the stock market. But I think focusing on quality companies is, in my experience, the better approach. I think far more investment mistakes are made from picking the wrong business than paying too much for a great business. And you can make mistakes in both those categories, but I think the more catastrophic mistakes are from selecting the wrong business.
Yeah, that's definitely true. I mean, if I could give advice to a younger self, it would be listen more to Toby. I always, take up the 2 examples of buying GameStop and Bed Bath Beyond. We have that on record, and both times Toby said, "Don't do it," and here are all the reasons why. And both times I didn't listen. And look what happened.
Did they work out? Didn't they work really well?
No, they really didn't. I definitely caught them at the wrong time. So we had you on there with Jesse Felder, and he made a fortune in Bed Bath Beyond because he's much smarter than me. So I bought it on the way down. Apparently, I misunderstood Wes's momentum strategy, so I bought it on the way down. Jesse bought it on the way up, lo and behold. So he absolutely made a killing in that. So I just wanted to say that. If I can give my 2 cents to really a younger self and not just a few years back and, listen to Toby, if I could give myself another advice, it would probably be Buffett said that he bought his first stock at age 11. And then, up till that age, he was just wasting his time. I kind of like that quote. Because Buffett talks about being a learning machine, and that's definitely something that I haven't practiced, definitely not since 11, that's for sure. But I always understood the intention of, compound interest and, why we need to accumulate capital, that investing that. But I never really understood the concept of compounding knowledge before I got into my mid or late 20s. And I think that's one of the things I would like to change. And the other thing, and this is just something I'd like to convey to our listeners too, is really to read more. I think one of the mistakes that I've made as an investor is, I speak to people and they're smart people. They're not necessarily as smart as you. But whenever you primarily speak to people, especially if you're not too selective, they tell you things you already know, or they talk to you about things you're not interested in, or you don't understand. They're speaking too fast. They're speaking too slow. Reading is just, you get it in just the right tempo and you get just what you're interested in. And it's a lifetime of knowledge put into 200 pages or whatnot. That I haven't done that before is just, I don't know, I definitely wasted my time until then. Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on the next podcast episode and new investing resources.
What are your takeaways and thoughts on this discussion? Let us know in the comments section below.